To make it easier to see this presentation, you can maximize your screen by clicking the little box that looks like this in the bottom right-hand corner of the video. So go ahead and click that icon now, and we'll get this webinar started, hosted by Darren Sugiyama and Lionsmark Capital. We hope you enjoy this presentation.
Hey guys, Darren Sugiyama here, CEO and founder of Lionsmark Capital, the most transparent premium financing intermediary firm in the life insurance industry. So as you know, I completely revamped my proposal layout this year to make it easier for clients to understand the benefits of premium finance life insurance, and also to make it easier for advisors to walk their clients through the proposal. And if you've been following my webinars and live boot camps over this past year, you probably know that we produce custom client videos of me walking your clients through their actual proposal. Now, this has been great from an educational standpoint, for the clients, because we upload the video to the cloud and then we circulate the link to you, the advisor, also the client, and then the client can forward that link to their spouse or their CPA or their attorney, even their Mr. Know-It-All brother-in-law. Or whoever wants to learn about premium financing and how it might be the right fit for your client. It also keeps you safe from anyone accusing you, or me, quite frankly, of not disclosing important elements like variable borrowing rates, collateral calls, and the volatility of cash value performance. Now, we keep this video in our CRM so that if anyone comes back years later and accuses us of not disclosing these types of variables, it's all right there in the video recording. So in today's webinar, I'm going to show you a sample of this new video format. It runs about 20 minutes long, and you'll be able to see the quality, the thoroughness, and the simplicity of how we articulate how premium finance life insurance might work for your client. You're really going to experience what the client will experience when they receive these videos. In this case study we're going to review, we used an IUL product from Hancock. And I must say, the product performs quite impressively, especially in our backtesting proxy. In addition, I recorded a Zoom call recently where I asked some executives at Hancock about what makes their value proposition so unique. And I'll share that Zoom panel interview with you as well at the end of this webinar. So without further ado, let's go ahead and get this started, beginning with a preview of the custom video format that we'll send your clients once they engage with us. So I thought I'd record this video of me walking you through the highlights of this premium finance life insurance solution that we specifically designed for you based on your financial needs as well as your current health status. Of course, we won't know your exact numbers until you go through full underwriting with the insurance company, but this will give you a good understanding of how the solution can work for you. The other nice thing about this video is that we uploaded it to the cloud, so you can watch it, you can pause it, rewind it, and jot down any notes. And I'm happy to jump on a Zoom call with you to answer any of your questions that you might have personally. Also, feel free to forward this video link to your spouse or your CPA or your attorney, or whoever else might be interested in learning about this solution that we designed for you. So without further ado, let's go ahead and get started. Since your goal is to provide the capital your beneficiary needs when your life comes to an end, we're going to take a look at 5 different options, some insurance-based and some non-insurance-based, just so you can see a fair comparison. So we'll start off with the outcomes first, and then we'll get into the granular details of how we arrived at these numbers. In green column number 1, we show the annual contributions going into the premium finance life insurance policy. And in the column just to the right of that, we see the ongoing net death benefit amounts that would pay to your beneficiary at your end of life, if you were to pass on in one of those given years. This is the amount net of all loans. We designed this policy so that the net death benefit hits a low point right here in the amount that you originally requested. We're also showing you drawing down similar amounts from the policy value a little bit later on to recover your out-of-pocket expense. So with the cost recovery drawdowns, here is your net cost. Now, you may decide at that point that you don't want or don't need that cost recovery component, and you might just leave the cash in the policy. If you were to do that, the death benefit amount would be much higher than what we're showing here. And you can make that decision at that time if you like. In the orange columns, we're showing you a non-finance life insurance policy, the same product. Now, and it starts with the low point death benefit you requested, and it stays level for the majority of the policy. Now, we see the annual contributions up top here, but there is no cost recovery in this scenario. So your net cost would be much higher than the premium finance life insurance policy, which is the one in the green section. Okay, moving on. In blue column number 3, we have a taxable non-insurance based investment account growing at the same gross return as both of the life insurance policies, with the same dollars in and the same dollars out. However, at life expectancy, that's right there in the black cell, we see a much smaller after-tax account value than the premium finance life insurance policy's net death benefit in that same year. Moving on, in blue column number 4, we have the same taxable non-insurance based investment account with the same dollars in and the same dollars out. However, in order to get the same after-tax value as the premium life insurance policy at life expectancy, it would require a much higher gross return than what we're showing in the life insurance policy. And then lastly, in blue column number 5, on the far right-hand side there, we show the same taxable non-insurance-based investment account with the same gross return assumption, the same account value at life expectancy, but it shows just how much more you'd have to contribute annually to reach the same result at life expectancy there in the black cell at the bottom. So we always want to show alternatives to the premium finance life insurance policy solution. But as you can see, in this specific situation we discussed, which is based on what you told us about your financial and health status, the premium finance life insurance solution in the green section produces a much more favorable outcome. So here's another way to look at evaluating whether or not adding life insurance as a separate asset class inside your portfolio is a prudent thing to do. We're going to take a look at a portfolio with your premium finance life insurance policy inside it, as well as without the life insurance component. We're going to assume the starting account balance up here in the top left-hand corner, along with this gross return assumption, this investment fee assumption, and these tax rates. And the blue column on the left shows the net value that Generation 2 would inherit if you were to pass on in any one of these given years. Now, in the green section, it shows the exact same portfolio assumptions. However, we see a small amount being repositioned into the premium finance life insurance policy, and then we see cost recovery drawdowns from the policy values reinvested in the taxable portfolio. And in the far right green column, we see that Generation 2 would net the after-tax portfolio value plus the life insurance net death benefit. And the graph on the right-hand side of the screen shows the difference in what you would pass on to Generation 2. The green line is the portfolio with the premium finance life insurance, and the blue line is the portfolio without the life insurance. A pretty significant difference favoring the portfolio with the premium finance life insurance policy right there in the green. So let's take a look at the premium finance life insurance policy design and the loan model. So in column 1, this is the actual annual premium that enters the policy each year. And in column 2, this is the premium that you would pay out of pocket. Column 3 is the premium that the lender is going to pay. In other words, the premium that you'll borrow from the bank, and they'll charge you interest each year on the cumulative loan balance. Now, these are speculative borrowing rates, obviously. The borrowing rates may be higher in the coming years, or they may be lower than what we're modeling here. With most lenders, they reset the borrowing rate once per year at loan/policy anniversary. So here we're showing the interest charged in column 6, and in column 7, this is the interest accrued. And in column 8 here, this is your planned annual contributions, the equity premiums plus any interest if you're not accruing the interest, And if you are accruing interest, obviously the values here in column 8 are solely the equity premiums from column 2. Now, in some cases, the lender might require you to post collateral here in column 9. And this would happen in any year where the policy value was less than the outstanding loan balance. Much of the collateral calculation is based on the policy performance and the cash value. So if the policy performs worse than what we're showing here, you might have to post a little more collateral. And if the policy value performs better, the collateral requirement might be a little less. And these amounts are assuming that you post cash as collateral. If you were to post marketable securities as collateral as opposed to cash, these numbers might be double what we're showing on the screen here. Okay, moving on. In this scenario, we're assuming this average rate of return here in column 10. Obviously, if the return is less, the cash value might be less. And if the return is greater, the cash value can be more. And later on in this video, we are going to talk about volatility and historical returns of the S&P 500 and how those historical index returns might affect outcomes. Okay, in column 11, we're showing the third-party loan payoff. That's the first number you see there in that column. And in later years, you could take tax-free drawdowns as a retirement income stream or as a way to recover the cost of your contributions you made in the earlier years. Or you could not take any drawdowns whatsoever and maximize the death benefit going to your beneficiary. The choice is yours, and the nice thing is that you don't need to make this decision up front. You can wait to make that decision when the time actually comes in the future. Because as you know, you may or may not want or need to take those drawdowns in the future. And then lastly, in column 14, we see the net death benefit in each given year. This is the net amount the insurance carrier would pay to your beneficiary, a net of all loans. And by the way, even though we're only showing a 40-year window on this page, the policy is designed to last until age 120. So we analyze 121 different 40-year historical periods of S&P 500 performance, and we built a proxy for the life insurance policy for the purpose of explaining how these charges and credits work during times of volatility. Now, we call this proxy a leveraged hypothetical synthetic asset, which is not the actual life insurance policy, but rather a fictitious asset that depicts a similar charges and crediting methodology as the real-world product. So this ledger shows the 40-year period that produced the worst compounded annual growth rate out of the 121 different 40-year periods that we analyzed. In column 3, these are the standard annual charges that are deducted first before any index credits. And in column 4, these are the back-tested years. Like, for example, in 1973, the S&P 500 produced a negative 41.4% return. And in that given year, your cash value would not decrease by 41.4% because you're protected by the 0% floor. Remember, this is after the charges have been deducted. However, in 1975, when the S&P 500 returned a positive 25% return, you'd hit the cap, which is the maximum allowable gross credit in a given year. Now, in column 7, you have a multiplier bonus feature. And the way this works is the index credit in column 6 would be multiplied by this multiplier bonus factor. Now, to get the multiplier bonus and raise the cap, there is an additional asset-based charge here in column 1, which is applied to the accumulated value. And that charge is subtracted from the cash value each year, which we see here in column 2. And you can make the election to opt in or opt out of this multiplier proposition at the beginning of each policy year. So in column 10, this is the index credit that would be applied to the end year accumulated value. Now, I know there are a lot of numbers on the page here, but to make it easier to understand the impact that these charges and credits have on the values over time, take a look at the 3 orange columns, column 11, 12, and 13. In column 11, those are what the credits in dollar amounts would have looked like in each given year. In column 12, those are what the total charges would have been in each given year. And in column 13, it shows what the net gain or net loss would have been to the cash value in each given year. In other words, the credits or debits to the cash value. Again, this is just a proxy for the real world product, but the spirit of this explanation is to help you better understand how charges and the crediting methodology works from a mechanical perspective. Now, let's take a look at how the hypothetical static outcomes depicted in the carrier illustration compare to the historical back-tested outcomes in our proxy. So this graph here shows a comparison between a static return assumption and our proxy's hypothetical performance, based on historical volatility. The black line is the death benefit as illustrated in the carrier illustration, assuming a static average rate of return. And the blue line represents the ongoing cash value under that same static assumption as depicted in the hypothetical carrier illustration. The dashed green line represents the hypothetical simulated cash value in the proxy during the 40-year period that produced the best compounded annual growth rate out of the 121 different historical 40-year periods we analyzed. And the dotted green line represents the worst 40-year period analyzed. In other words, the 40-year period that produced the worst compound annual growth rate out of those 121 different historical 40-year periods that we analyzed. And then the solid green line depicts a hypothetical 40-year period that started in the year 2000, wherein there were 4 zero index credits that would have occurred within the first 10 years of the sequence. And during this period, we also used the actual historical borrowing rates during this time. And then we run that sequence forward all the way up until last year. And then we use the same static return as shown in the carrier illustration in the remaining years. So we think it's important to understand that based on how the market does, as well as the future of borrowing interest rates, that there's a range of potential outcomes, right? Not only with the cash value, but also with the potential income drawdowns. If we look at the green box in the bottom of the legend there, you can see the variance in cumulative drawdowns that may be possible, based on the static as illustrated returns in the life insurance carrier illustration, compared to the various sequence of returns and volatility in the proxy during versions depicting the best 40, the worst 40, and that hypothetical 40-year period that started in the year 2000. The value of this particular slide is to understand that there could be, again, a range of outcomes based on what the actual index does over the next 40 years, what interest rates do over the next several years, and based on the sequence of returns. And one last thing to understand about this slide is that it is possible that the next 40 years might produce an even worse outcome than the 40-year period that produced the worst compound annual growth rate out of those 121 different 40-year periods that we analyzed. Just like it is also possible that the next 40 years could create an even better outcome than the best 40-year period that we analyzed. And lastly, we compared the solution to an equities and bonds account. For the equities, we used historical S&P 500 returns, and for the bonds, we used historical T-bond returns. 70% of the portfolio is in equities and 30% in bonds. And here's the comparison showing the best 40 and worst 40-year periods. The green dashed lines represent the greater of the as illustrated death benefit in the carrier illustration and the simulated cash value in the proxy. Now, in a real world scenario, if the policy's cash surrender value eclipsed the as illustrated death benefit in the carrier illustration, the real world death benefit would increase with the policy cash value because the death benefit must always be equal or greater to the policy's cash value. So these green lines symbolize this scenario, again, using the proxy as the hypothetical example. And the blue dotted lines represent the net amount that would go to Generation 2 in a taxable equities and bonds account using the tax rate assumptions we've been talking about throughout this report. Again, these are the same two back-tested 40-year periods, both the best 40-year period and the worst 40-year period out of the 121 different 40-year periods we analyzed. So if you're looking to solve a liquidity need in the future at your end of life, Would you rather pass on the green values or the blue values, right? I mean, I think the answer is pretty obvious. So the pages we reviewed in this video only provide a brief overview of an extremely thorough 50+ page analysis. The summary is not intended to be the sole source of information used in making any financial decision. And you should have been provided a full report that includes all of the ledgers that mathematically explain how the outcomes depicted in this video were calculated in full transparency. And if you haven't received this full report, you can request it by emailing us at support@lionsmarkcapital.com. And always remember that any decision to purchase a life insurance policy or any financial instrument for that matter should be made after reviewing the official carrier illustration and the full report with your financial, legal, and tax professionals. And lastly, I am an internationally acclaimed author and expert on this topic. I have my books being distributed currently in 14 different countries in addition to the US. And one of my books, Premium Finance Life Insurance, The Key to Effective Estate Tax Planning, is available on Amazon. And I publish an updated version of this book each year, so make sure you get the most recent version. So I hope this video was helpful, as its intent was really rooted in education and full transparency. And again, this was just a brief summary overview. So if you have any questions, again, happy to jump on a Zoom call with you personally and help you navigate through making this really fantastic decision for you and your family. All right, so today we have some heavy hitters from John Hancock on the Zoom call with us today. If you go around the horn real quickly and introduce yourselves, as well as your title and also what you do with John Hancock, we'll get us started, and then we'll get into some pretty deep, hot and heavy Q&A with you guys. So Paul, why don't you lead us off?
Sure. Thanks, Darren. Really appreciate the opportunity today. I'm Paul Adelson, John Hancock. I'm the National Account Manager covering the producer groups for Lion Street, FFR, and EPG on a national basis here at the company.
Hello, everybody. My name is Kevin Yurkovich. I'm the Regional Vice President, Wholesaler in Southern California. Thanks for having us, Darren.
I'm JJ Bowman. I lead Market Solutions, a new function at John Hancock, focused on bringing great new solutions into market with partners like yourself, Darren, and I'm very happy to be here.
Well, I'm again very grateful all you guys are on the call here. Got some great minds in the life insurance industry with us here. Wanted to kind of start off by talking about probably one of the biggest things that sets John Hancock apart from other carriers, and that is vitality. I'd like to get into a little bit about how vitality can affect policy performance as well as incentives for producers, and then also get into the strength of John Hancock's general account. Let's go ahead and start with vitality. Maybe, Paul, you can lead us off here. How does vitality affect the index credits and the growth of the policy cash value over time?
Thanks, Darren. Obviously, vitality is a major part of what we do here at John Hancock, and our commitment and passion has become helping clients live longer, better, and healthier lives. And one of the things that I think goes unnoticed a lot of times, especially when I speak at study group meetings, is how it can actually impact policy performance on accumulation sale. With vitality, we do generate credits inside the policy when the client engages in our vitality program, and it will end up in creating literally hundreds of thousands of dollars of additional cash value potentially in exchange for $24 a year. And every time the client engages in our vitality program, it will generate 20 years worth of credits inside the policy. And then the next year, if you engage again, it will generate another 20 years of credits. So credits upon credits. So that's how we can increase that cash value. And if we're talking about a premium finance case, I like to tell everyone, hey, not only is this a great way to generate additional cash value, but on premium finance, you can also potentially roll out of the loan even sooner, saving you a tremendous amount of money on interest costs as well.
So are you finding that folks that are already kind of fitness and nutrition minded, do they tend to gravitate towards this and identify with this product more because they feel like it's kind of built for their lifestyle?
I would say yes, and also there's an additional group of folks that have had a health event that gravitate towards this vitality program even more. And we've seen that through studies that we've done with literally thousands of participants. Somebody that has had a health event, now they become extremely motivated to get on the treadmill, watch what they're eating, sleep better, all of these different things for which you can get points for in the program.
So what I'm hearing is that it's not exclusively for like fitness gurus and health nuts. It might be for someone that was living maybe a not so ideal unhealthy lifestyle and maybe made a change for the better, because vitality credits on activities that the client does, right? Not necessarily what their initial health marker is coming into it. Is that accurate?
Correct. And so the vitality program can help anyone, whether they're already super preferred or they're rated. And by participating in the program, you're going to get additional cash value on an accumulation sale, or you're going to save on your premiums on a protection sale. Because on accumulation, we want to max fund the policy, right? We don't want the discount, but on a protection sale, we do. So I often show an example of a person who was rated at 200%, and by getting a platinum status, they literally shaved 4 tables off of their price. Because if we didn't have vitality, in order to get that same platinum level discount, they would have to improve 4 tables, is another way to say it. So this is available to our clients all day, every day, never goes away, even on a super preferred rating.
Interesting. Okay. And now, Kevin, you were talking a little bit about the effect that vitality has or can have on producer comp as well. Could you touch a little bit on that?
Yeah. Before I do though, Darren, I just wanted to comment that, in almost all aspects of life, we're used to being part of clubs or incentives. And we like the rewards, whether it's an airline club or a credit card miles club. We participate actively in those types of things. And I think, unfortunately, our industry is rather dated. We haven't embraced technology like we should. So I think John Hancock offering Vitality Plus almost 10 years ago now is really a leadership role in the industry of saying, we want to help our clients engage and live longer, healthier, better lifestyles. And in turn, that helps the carrier, because if we can extend LE and pay out that claim a few years further, that's good for us. But it really also helps the clients as they engage with us over the lifetime of their policy. So to have that real interaction between the carrier and the primary insured is very unique in our industry and something that we're proud of. One of the things that we do frankly need, though, is the buy-in from the agent to help explain it to the client. And to do that, we help compensate the agent in 2 ways. When you elect Vitality Plus on the policy, we're going to pay a 7% agent level bonus. And when you help them register for the online computer or app portal opportunity to engage with us regularly, it's an additional 5 points bonus. So on every case, an agent can look at 12 points additional compensation. And we also wanted to make sure you're aware of our enhanced targets, because the 1-2 punch of enhanced targets and vitality bonus can be very meaningful. There's certain clients that want to short pay their design. And if they do, we want to incentivize the agent for that. You can see in this example with Protection IUL in the slide here that if they pay 4 times target in year 1, the actual target will increase by 20 points. And then we can get another 12 points on top. So I don't know too many agents that aren't looking very kindly and excited about a 32-point bonus on that sale that they would have made otherwise. So those are some highlights about not only vitality, but how we compensate agents for their participation.
Yeah, that's great. I remember in a previous conversation, I think all of us had, you guys were talking about the fact that vitality could be used specifically on a rated case, the benefits of that. Can one of you maybe speak to that a little bit?
I just like to use it as an example of they can earn their way back to standard, or they can earn their way back to preferred. So we've all had those cases in our career where the client tells us they're perfectly healthy, and when we go through underwriting, we get a different opinion from our underwriters. And you got to ask yourself, is that table 2 or table 4 case dead in the water over pricing and sticker shock at that point? And so to allow your client to earn their way back to a standard or maybe even a better price point through participation and vitality is really key. And again, it creates that mutual partnership. We're asking them to engage with us and live in a healthy lifestyle and do some things to better themselves. And in turn, we're going to pass that premium savings back to the client. So it's almost like a client generated table reduction program, if you think about it.
Yeah. What about caps in terms of not only just how vitality affects performance, but also maybe talk a little bit about historical caps and how you guys have stacked up against competitors? I think that's a really big thing right now, as we've seen caps fall in some areas with certain products. Seems like you guys have really worked to keep those caps where they have been in the past. Maybe you guys could, maybe JJ, if you could speak to that a little bit.
Yeah, absolutely, Darren. Just to put a pin too on the one thing on the vitality conversation, to Kevin's point is, and Paul alluded to it as well. There's this sort of actuarial symbiotic relationship here with what we do on vitality and back to the customer. When you have a customer who's substandard, they're going to have bigger cost of insurance charges, and their vitality credits from a dollar perspective are going to be bigger. So I would really urge anybody who has a rated case, don't think of vitality as just a something for people who are health nuts, if you will. Think of it as something that can really help as part of your overall life insurance planning. And the bigger the rating, the bigger the benefit's going to be on vitality.
Hey, JJ, just one other point there I don't want to miss. We've actually gone back to our pre-COVID guidelines on over age 80, and we'll allow up to a 200% rating now. So during COVID, insurance carriers didn't even want 80 and up. And then they had a secondary set of rules that said you had to be standard or better. So we've actually just changed that back to 200%. So JJ's point is really important to remember, but also note that we can hit that over age 80 market now, which always drives really nice cases.
Absolutely. We have long had expertise in that area, and we continue to do, and we want that business. And so Darren, back to your question, what do we, how have our caps performed and how have we done? For us, it is really important to have products that look great the moment you're showing them as an agent to your customers. That means you have to look good and competitive on the illustration, but that's just the beginning of the relationship, right? The key to having a successful experience with a company is to make sure that policy has the potential and has the ability to outperform what's on the illustration. And in our indexed UL book and in our universal life book, we have a great track record of still really delivering strong performance year after year after year. And when you think about what does it take to maintain a competitive cap? It's not just, the company makes a decision, how much do we like our customers this week? And, that's going to determine what our cap is. It all comes back down to the economics. Because sooner or later, you can kind of kick the can down the road, but you're going to have to, react right to the actual economic realities of what is your general account earning. And that's going to ultimately be reflected in what you're able to support as a cap. All of the companies, for the most part, we're buying options on the S&P 500, so we have sort of the same exposure to the cost of the options and where interest rates are, where short-term interest rates are. So really, the big differentiator is going to be what's that portfolio yield that you have in your company. And one thing, and you can see here, by the way, in this example, is just us relative to some of our competitors, and you see that we've been able to perform really, really well. And in March of 2024, this product series, which is our oldest product series, our very first indexed UL, it's going to see another increase in its cap, and it's going to go up to 9.25%. So that's another really, really positive story. And there's one other slide I'd love to share with you, which is our how our alternative asset classes have performed, because that is another key part of the story here. So I'll just share my screen, and what you're looking at here is our alternative asset portfolio. And this has been a real driver, especially in our protection indexed universal life product. We have had this expertise in alternative assets going back decades, I think well over 30 years, 30 plus years now, really investing in these types of asset classes. So that includes corporate real estate, timber, actual farmland, power infrastructure, private equity, and oil and gas. And the nice thing about this asset class, it takes up about 18% of our general account portfolio, which is, by the way, same as you can see from very large U.S. mutual companies that also like to talk about their alternative asset book. It's a real value add for an insurance company. And what we've been able to do is develop products where we can help customers share in that. And the real benefit that you get as a customer is that return. The return over this 10-year period, and this goes back through 2022, we'll be able to update when we release our fourth quarter earnings shortly. But through 2022, 10-year period ending in 2022, that's about a 9% return that we've been able to deliver in that part of the portfolio. And our indexed UL customers are able to benefit in that performance. The other thing that you see is the standard deviation, or the volatility that you get with that asset class versus what you would get with just the S&P 500, significantly less volatility. And that's, from an investment standpoint, that's what you're talking about when you're talking about the efficient frontier and what you're able to deliver with a greater return for less amount of risk. We found a way to help our customers benefit from that. One other thing I'll just share with you, a couple other things, I'd share with you here is, as I said, our first indexed UL, that's at a 9.25% cap. It's also over an 8.5% return since it was first launched. And but the way I'm calculating that is by taking the average return every year of each of the segments that we've had over the last 12 plus years. And we're delivering over 8.5%. That is higher than our maximum illustrated rate has ever been. So when you hear sometimes, throughout the discussion, some people may ask, well, indexed UL, it seems like a great product. It protects the downside, it gives you upside, but can you actually deliver those returns? We have the actual experience to be able to say, yes, indeed they do. And we have customers who are benefiting from that general account investment performance.
Excellent. JJ, if you could kind of expand a little bit further on the power of, or I should say the stability of Hancock's general account. We had a conversation a few weeks ago about that. Now, I found it really insightful. Could you expand on that a little bit?
I'm sorry, I cut out just a little bit there. We
had a conversation just a few weeks ago about the strength of John Hancock's general account and how that affects performance overall that ends up benefiting the client. Could you expand on that a little bit?
Yeah. So, as I talk about with the alternative assets, that's just one slice of the general account that we're investing in. I think what we've been able to do is find all of this expertise and areas of good yield that is a good match for the risk that we're offering the product, the customer, and being able to put that into the product. And so another example is we're looking at now in a situation where interest rates are higher than they obviously have been. We're able to also look at other parts of our general account where there are some higher yielding assets, and how might those assets might be able to benefit our customers. So as we are updating our products for 2024, and the first one you'll see is our protection indexed UL product coming out at the end of February this year, you're going to start to see that the fixed account rate on that product is improved considerably because of our ability to match the best investment opportunities within our general account to the products that they serve. And another thing I would say too that's beneficial, the way that we approach kind of managing the in-force customers, is our products we take a portfolio approach with our investments. So even if some newer products might be able to see some benefits of higher short-term interest rates because they're newer, over time our entire index portfolio is going to benefit from that. That's different than where some other companies might take a new money approach and then sort of cordon off an older product series, and those customers aren't going to get the benefit of those inflows from their customers. So I think that's just another way that we've shown that we have this really strong general account It's been very stable, performing well, and we've had the expertise to find how do you take that yield and then put it into the policy where the customer can benefit over time.
And then lastly, I'm under the suspicion that folks outside of the financial space, outside of the life insurance industry, may not be aware of certain multi-billion-dollar life insurance companies, but I don't know anyone that doesn't know who John Hancock is. How do you, what's your take on the value of that brand name recognition from a consumer standpoint? Maybe someone that's not living in the financial and insurance space every day like we are.
Well, I think that little fine print that anybody who's ever sold life insurance policy can find, right, is that all of these assumptions are based on the claims paying ability of the issuing carrier. And we sometimes can take that for granted that, okay, everybody's going to be around and it's just all going to go. But we see in industry after industry after industry that, companies that, things can go south for companies. So you do want to be able to, take a look at the financial strength, take a look at the balance sheet. How are they investing? How integral is life insurance to that company's bottom line? I think those are all really good things to look at when you're just evaluating, not just at the illustration level, but at the carrier level, to make sure that you're comfortable sharing, presenting a company. And I think at John Hancock, we really do, check all of those boxes. And I'll stress too on the, the importance of John Hancock. We're a global life insurance company. We have operations in Canada, Asia, and the United States. But the life insurance that we do in the United States is considered, absolutely key to the overall global business strategy, which allows us to continue to invest and, kind of find new markets. And we're really excited about expanding with our partners over these next, hopefully not just years, but decades to come.
Excellent. So as we wrap up here, I mean, you guys know I work with advisors all over the country. What would you say if you had to, this is a hard question to answer, I think, but if you had to pick one major reason why advisors should be taking a closer look at John Hancock right now, what would that one thing be? Maybe let's go Paul, then Kevin, then JJ.
No, great question, Darren. And my hope today is if there's one thing that the advisors take away, it's that the illustration doesn't tell the whole story. The real world performance is what matters the most. And a lot of our value really comes off ledger. And that's in the form of the cap stability that JJ just alluded to, the ALDA strategy that we have that really sets the landscape for everything that we do. And then vitality, obviously, is a major differentiator for us and will continue to be so for the foreseeable future.
On that note, Paul, in your opinion, has Hancock not been on the front burner for a lot of advisors for that very reason? They're shopping illustrations as opposed to really looking at the intangibles, the things that aren't going to show up on a carrier illustration ledger.
100%. Unfortunately, that's been the practice of our industry. And I get it. Sometimes habits are hard to change. But when it comes to that annual review with your client, you want to have the best probability that you're going to outperform what you illustrated. And I think our company definitely stands up in that category.
Excellent. Kevin, same question.
Yeah, I would just expand on Paul's points. They were great. It's hard work to be a student of this game and to know all the carriers and all the products. And it's almost an infinite amount of things that we need to know when we go out and represent our customers and try to offer them life insurance. To really know the products and inside and out beyond the illustration takes a lot of dedication at the agent level. So it's important that not only do they take that to heart and make that a priority in their business, but also reach out to people that can help them. Our PICS team, which is our competitive intelligence team, is awesome. And we need to use them, and you need to know how to get in touch with them to work a case and to look at it. And you know what? They're really fair. If there's another carrier that's beating us, they're going to tell you that. But if there's reasons and ways that we think we have a more compelling story with Hancock, they're going to show their best foot forward and show you that as well. So I think, as Paul stated, you might out illustrate us, but you're not out going to perform us long term. And we've got the track record and the math to prove that. You talk about, not chasing that new money rates and walling off old blocks. Carriers that have a new product every year, it's the 16 product, and then it's the 18 product, and the 19 product, and the 20 product. Those older policies are now having their caps reduced. And I just saw some news from another carrier recently that all their in-force block caps were reduced to 6 to 6.5%. There's no value in IUL at that point going forward. You're basically making a fixed UL policy with options costs. So I think it's really opportune time to look at us. There's a lot of great carriers out there, and the one thing we have to do every day is earn it. And we think with underwriting, product, vitality, and the total package, we think we should be a carrier that gets a shot to earn your business routinely.
I love what you guys are saying about the carrier illustration. The fact that that document should not be in isolation, the sole thing that folks are looking at when making a decision. To use a analogy, I guess you could spreadsheet a bunch of different cars, but everyone's got their preference, right? Some people like Lamborghini over Ferrari, BMW over Mercedes, vice versa, Honda over Toyota, whatever it is. And spreadsheeting something like this, in many ways, I feel has almost kind of done our life insurance industry a disservice, and ultimately the client a disservice, because it really doesn't tell the full story that someone ought to hear when making a decision this important and this large. As you guys know, I'm a watch collector, watch enthusiast, and one of the things I heard that really I thought was a great analogy to buying life insurance is that when you're buying vintage watches, I'm talking about high end, tens of thousands, not hundreds of thousands of dollars worth of watches. All the experts in this space will say you can't just look at the watch, you can't just look at the price. What you're really buying is you're buying the seller. You're not buying the watch, you're buying the reputation of the seller, because the reputation of the seller is going to tell you how much due diligence has been done and making sure this watch is authentic, that the parts are original, et cetera, et cetera. And I think from my conversations with you guys, that concept definitely applies to Hancock's value proposition, because for years, I wasn't all that interested in writing John Hancock, quite frankly, because it didn't illustrate well. And the more I get into the vitality and the cap history and the strength of the general account, all of a sudden, being a self-proclaimed mathematician, I'm really looking at what is the real value here, and where is the industry missing the boat? And it sounds like you guys are hitting a lot of bullseyes here. JJ, what's your take on this? What should advisors be focusing on with Hancock?
I'll just build on what you said and Kevin, and finish with 2 R's: resources and relationships. From the resources, Kevin mentioned, we have a competitive intelligence team. We've got a great advanced market team. We have myself, we have Kevin, we have Paul, and we have a team of people ready to help you. And I would also say too, we talk about the illustration not being important. We do illustrate very, very well, extremely well on the protection side. On the accumulation side, sometimes we may be down the list, but there's always parts to the story that we can kind of share with you. And that leads to the last word, which to me is relationships. These commitments, are, could be 10 years, 20 years, 50 years. You can have a policy in force for 80 years. And to be able to have, people that you can rely on at the home office that you can work with. I just worked with a producer on a case last week, and it was a difficult case on an enforced case with his client. We're strategizing about what we can do. And after the call, he sent me an email that I had sent him from 2005, where we had been working together, to have that sort of relationship with people. And that happens all throughout the business. So I would just say, if you don't have a great relationship with John Hancock yet, there are ways to do it. And we would love to have that honor of kind of creating that long-term relationship with you.
Fantastic. And I definitely appreciate my relationship with you gentlemen. You've been extremely helpful and patient, by the way, patient in going through the details with me, things that a lot of folks might not have the patience to go through all my crazy iterations of analyzing a product. But I must say I'm extremely impressed and looking forward to having a great year with you guys. And any closing comments you guys have?
I would just add
more Hancock, Darren, in your premium financing models.
and I would give one more plug to. I just hope that everybody can join us in Greece next year. That's our trip. Qualification this year, January 1 to December 31st. I believe it's 450,000 if I have it right. But fantastic. We'd love to have more the merrier.
Excellent. Again, appreciate you guys. Thanks for joining the call, and we will look forward to having a great 2024 with you guys.
Thanks so much.
Darren. Thank you.
Yep. I said it before and I'll say it again. Life moves pretty fast. You don't stop and look around once in a while, you could miss it.